Hello, hello, hello. Welcome to episode 23 of the Inevitable Wealth Podcast. Surprise, folks. We don't have Julian today, if it's not obvious. We have Chris here. And I think because we are in tax season, you work with a ton of families that get like equity compensation, pharmaceutical space, and all that fun stuff. It would be a good idea to have you on and just talk about really what does it mean, right? Folks say, hey, I was granted equity of my company. They're excited. So let's just dig into it
Okay.
and break that apart for us, Chris. Like what does it mean when someone says, hey, I was granted equity compensation with my company?
Yeah, absolutely. So the way I like to think about it is it's just a bonus, essentially, right?
Okay.
It's a bonus tied to ownership in the company.
Hmm.
So there's going to be components of investing and income to it that
Hmm.
that need to be considered, right? But often it's just a promise, right? Until it actually vests,
Yep.
right? So a lot of people think on paper, oh my gosh, I'm worth $1 million. Well, in all reality, you're not. That money is not realized until it actually vests to you,
Hmm.
right? So there's a lot of different things that go into it, right? There's the grant of the equity compensation
Hmm.
initially. It vests over time, and then you could potentially exercise it, right? Sell it. So there's a lot of moving parts there,
Hmm.
and there's also a lot of different types of the equity compensation as well, right?
Got it. Got it. Yeah, that's a good point you mentioned. Folks I think sometimes don't realize, hey, they have this equity. They can see it, they log into their
Mhm.
portals online,
Yep.
and they think this is actual dollars they can touch, they can use. And in many cases, it isn't, right? You got to wait,
Absolutely.
you got to be with the company a certain amount of time for it to vest. Funny story, we worked with a young gentleman who worked at Peloton when Peloton was on
Oh,
its
I
rise
remember this. Yeah. Yeah.
during, pre or during the pandemic and a little bit after the pandemic. And at one point in time, he was like in his mid 20s and worth like $3-4 million, but he couldn't touch it. And
Absolutely.
then,
Yeah.
we know the story of
Yeah,
Peloton
yeah,
and it
yeah,
came back down.
and because it was options, it all became worthless
Yeah,
eventually, right?
yeah.
Which we'll get
So,
into that, but
yeah,
yeah. So definitely, don't get ahead of yourselves.
yeah, yeah, yeah. So, all right. So let's break down. I think the first one. So folks see this all the time. RSUs,
Yep.
right? And I'm going to play the layman card here, people. So RSUs, what does even RSU stand for? And like break down like what does that mean if someone says, "Hey, I've got RSUs."
Yeah. So RSUs are restricted stock units.
Hmm.
It's pretty much it's the simplest form of equity
Yeah.
compensation, right?
Hmm.
So you're granted shares, right, at a certain date. And then there's a vesting component to
Hmm.
it as well, right? So typically the most common I see is either it vests, 1/4 per year for the
Hmm.
next 4 years or 1/3 per year for the next 3 years. And the shares themselves don't actually aren't taxable to you until they vest, right? So you don't really have a say of when the tax
Hmm.
actually is paid,
Hmm.
right? So let's say you're granted, stock at the beginning of this year, it vests at the beginning of next year. You're taxed at the value of the shares at that point in time, and it's just like W-2 income, right?
Yeah.
And then once it vests, those shares are yours, right? And you can do whatever you want. You can sell them immediately. You can hold on to them, and you have some flexibility around that, right? But also one thing I wanted to mention: a lot of the times on those vesting periods, taxes are withheld typically in the form of shares, right? So
Oh, okay.
they calculate the amount of tax that you're owed, and then they just withhold that number of shares, right, equivalent to the tax, right? So that's one thing that's important to note as well. Is that tax going to be withheld for you automatically, or do you actually have to front that bill?
Got it.
Mhm.
Got it. And so like again, everyone's situation is unique. Everyone's situation is different, and this
Mhm.
is not tax advice or investment
Yes.
advice, all that fun
Yes.
stuff. But would you, with some of the families, like more often when those RSUs vest,
Mhm.
like are they keeping the stock? Are they selling it?
Mhm.
Like what are the tax implications? The vesting is one tax, right? But like
Yep.
if they sell day one,
Yep.
right, the stock vests and their RSUs vest and it's at $100 a share and they sell it day one at $100 a share.
Mhm.
Like, what does that look like tax wise?
Yeah.
And, do people typically do that or they hold on or what would that
Mhm.
look like?
Yeah, so that's where we come in, right? And
Mhm.
we work with the families that we serve to determine when it makes the most sense to
Mhm.
sell those shares, right? again, once it vests, it's stock just like you would have in a regular brokerage account, right? So if it vests at $100 and you sell it at $100, there's no additional tax, right?
Okay.
At that point, you're subject to capital gains tax.
Sure.
So if you invest at $100 and you sell it at $110, you got $10, of gains per share. Obviously, you have to determine if it's short-term or long-term, right? So if you hold it for more than a year, then it's long-term capital gains. If it's less than a year, it's short-term, right? So we work with our clients to determine when it makes the most sense to sell those, because there is an additional tax implication to it as well if they hold.
No, that makes a lot of sense. Anything to add about that, or I think we should talk about like options?
Oh yeah, this is where it gets complex. Yeah.
Full disclaimer, guys. Chris loves this stuff.
I love it.
He likes the complex. So stock options, again, many folks have them out there.
Yep.
Is, I would say, probably the most common type of equity outside of RSUs that we see.
Absolutely.
So there's ISOs, right, for short, and QSOs are non-qualified, right? Incentive stock options, non-qualified stock options. What are the high-level differences?
Yep.
And you know what? Let's start with like ISOs first, like what that is, what that means, and then we can go.
Yeah, absolutely. And I'll take a step back even further, right? So options in general, right? It's the company granting you the right to purchase the stock at a certain price, right? So it differs a little bit with restricted stock units where you just get the shares flat out. This is giving you the option to purchase the shares at a certain price, right? So it can be much more lucrative over the long term. They can also be worthless. Right?
So refer back to Peloton.
Yes. So again, just a quick example, right? If the company says, hey, we grant you the option to buy shares at $10 per share, right? It vests and all of a sudden the shares are worth $20 per share, right? You can essentially purchase those shares at $10 per share still, even though they're worth $20 per share, right? So now there's obviously, like Jacky mentioned, the ISOs and NQSOs. ISOs are incentive stock options, right? So there's actually a component to ISOs where there can be a tax advantage, essentially, if you meet certain holding periods, right? So I remember, and you probably remember this too, when we were studying for the CFP, egg. So if you hold those options for a year after exercise and at least 2 years after the grant date, egg, then you get favorable tax treatment, meaning that the spread or the difference between the strike price, which you could buy the shares at, and what they're valued at now is actually taxed at long-term capital gains rates.
Got it.
There's a little bit more complexity there. You might be subject to AMT, alternative minimum tax, right? So there's a lot that goes into determining, when we actually want to go ahead and liquidate those shares. NQSOs are non-qualified stock options, a little bit simpler, right? You don't get a tax advantage if you hold for certain periods of time. Essentially, when you exercise those shares, that's when you're taxed, and you're taxed at ordinary income tax rates. And then you hold the shares after that, right? And you can sell, and then you're just subject to capital gains tax from there. So a little bit simpler, but yeah, you don't have as much of a choice, right? In terms of the tax implications there.
And I'm gonna, thanks for breaking that down. And I'm gonna just throw the layman flag.
Sure.
Again, guys, absolutely. Chris sees this stuff all the time. And I want to break it down even like just very simple, like what an ISO, right? And like how that actually works, the mechanics, right? So January 1, you have the grant.
Correct.
Right? And then you have to exercise when for the people.
So there is also a vesting component to it as well, right?
So it's vested.
So once it vests, right, then you have the option to exercise it, right? Which means that you would buy the shares at that certain price.
Got it. Okay.
So you don't need to exercise right away once it vests. Typically, you have about 10 years actually to go ahead and exercise those shares. And then you are able to exercise at any point in time once they vest to you.
Got it. Perfect. So January 1, let's say it's vested, you exercise, so then you have to wait the year to get the incentive of long-term capital gains.
Correct.
So in that year's time, the risk is, hey, maybe when you exercise, the stock was worth $100, but maybe in that year's time, the stock can go up to 150 or down to 50, right? So like
100%.
that's like the risk. So really, a lot of like what you work with families is, I always hear Chris talking about this all the time, is like, hey, like, let's be defensive.
Mhm.
Let's plan, if you want to keep exposure, you want to take advantage of what the potential growth if the company's on a uptick, right? We want to be defensive. And I think, and I want to speak for your families, we see a lot of folks sometimes have that confidence in their company,
Oh, yes.
and they want to hold for a long time. But sometimes it's like, hey, let's just pay the tax rather than paying tax on less money, right?
Yes.
Yeah. So
Ultimately, a lot of times it comes down to a tax decision,
Yeah.
right? Obviously, like I said, there is the investment component to it, but the taxation is where you can really get burned, right?
Yeah.
So that's what we have to weigh out for a lot of the families that we work with.
nice. Anything to add when, like, for folks who have ISOs or non-qualified stock options, like, just like high level, anything to add to that piece?
Yeah. So the one thing I will say, right, and I think this is where people get tripped up a lot as well, is it's an option to purchase the stock, right? So typically the way options work is you need to actually front that money to buy the stock. So if you have, 100 options at $10 per share, right, you need to actually have the cash available to purchase those shares.
Yeah.
Now with non-qualified stock options, things can get a little bit simpler. You can do what's called a cashless exercise. So essentially, if they say, again, back to the initial example of, you can buy the stock at $10, it's now worth $20. You can do a cashless exercise where you don't have to put up the money. You can just get the difference between those two values, right? So you would just get $10 per share, and that's ultimately what you're taxed on.
Nice. Yeah, that's another good point. A lot of folks don't realize, with like RSUs, you're given the stock, right?
Yeah.
Or I guess you earn it, right? Because you work there.
Absolutely.
But for those ISOs, you got to pay for them.
You got to pay for it. Absolutely.
Yeah.
Absolutely.
Awesome. So let's move on to I think just taxes and like timing, really high level when you approach the planning for your families. Like, what is like your thought process? Like, do you have typically kind of like a decision tree in your head when someone says, hey, I've got these stocks, they're vesting in April, and they're usually high income families, right? Because they're high up executives in pharmaceuticals. So what are your, like, how do you frame up the decision making when you are approaching like the stock conversation?
Yeah, and this is where we come into play, obviously, right? With restricted stock units, again, it's a little simpler, right? Because you can't determine when you get taxed. It vests and you get taxed at ordinary income tax rates, right? Then the decision becomes, do we want to hold the company stock for a period of time, or do we want to sell immediately, right?
Yeah.
I think one of the first things I look at is just their exposure to the stock and the company in general, right? So we want to avoid having a concentrated stock position, essentially having more than 10% of your portfolio invested in one specific stock, your company stock, for instance, right? So that would be the first thing, right? If they are overexposed or over concentrated in that one stock, a lot of times it makes sense to diversify, right, over time to limit that risk. If they are not overexposed, then we look at the company in general, right? And we see, hey, is there opportunity for some solid growth, right? And do we want to hold, or do we continue to diversify, right, and reinvest those proceeds? For the options, it's a lot more difficult, right? ISOs specifically, right? We want to meet those holding requirements to get favorable tax treatment, but then we also want to weigh if the stock potentially, pulls back. Then it might not make sense not make sense to exercise those, right? Again, you typically have a 10-year time frame to look to exercise. So if you're in a very high income year, we might wait until that income comes down a little bit, right? If you have some different income waves, let's call it, right? We might look to wait till like a lower tax year to actually exercise some of those. And then also, do you have the cash available to put up for the ISOs, right? Because that's how you get those favorable tax treatment. For non-qualified stock options, again, we're looking at income in general, right? And determining if it makes sense on top of, hey, where is the company at? And what's the opportunity for growth there, along with your concentrated position, again. And then we also, one thing to note is that typically the taxes withheld are at a flat rate. So a lot of these high income earners, they're in the 30% plus tax brackets. Typically, their taxes withheld at 22%. So
wow.
a lot of people get surprised when they go to do their taxes the next year and they find that they're hit with this massive tax bill. So we strategize around, hey, let's, if we do end up exercising options, we typically keep a good amount of cash on hand so that we can cover that tax bill when the time comes, or make estimated tax payments as well.
No, that's I mean, you can tell there's so many moving parts when it comes to like equity compensation and playing around it, because then you have the tax conversation, you have the income, how it affects your income and your tax brackets, and then sometimes you have to really think about just the risk of the company itself.
Absolutely.
Right? Like,
yeah,
we have a lot of folks who work at companies, pharmaceutical, and even some utility companies, right? Like, we both have a lot of friends that work at Constellation. Remember, Constellation was on the rip, and people had options, and it pulled back. And I think that's one thing that we help a lot of our families is say, hey, like, there might be confidence, there might be a lot of growth, and we might be actively seeing the growth in the company, but that doesn't mean that we should be aggressive with our options, right? Like, it doesn't mean we should let it just overtake our portfolio. And because folks sometimes, especially later years, close to retirement, they're getting all these grants and incentive compensations is coming in, and then sometimes hundreds of thousands of dollars of company stock.
Oh yeah.
Right.
Yeah.
And because the company's doing well, they sometimes let it, like, hey, like, hands off, let it do its thing.
See it all the time.
Yeah. And we try our best to make sure that we manage that risk and make sure no one is going too far, right? Like Julian always likes to say, just because there's no traffic doesn't mean you should speed.
Absolutely.
Right.
Yeah. So absolutely. Couldn't agree more.
So what anything else to like really kind of talk to? Because I want to talk a little bit about 83B elections, which might be, he got excited. It might be not for most folk, not for everyone, equity compensation, but I think a lot of people can also benefit. But before we move that, anything else that folks should think about when it comes to just tax planning, how it affects their income or anything like that?
I'll say the one other piece, especially with the ISOs, is I mentioned that AMT component, and not to get too far down the rabbit hole here. I'm sure we could have a whole nother podcast talking about this, but if you exercise those options and then you want to wait a year until you sell, and that stock goes down, you might be subject to AMT tax on income that you did not actually earn. And then the stock goes down, and you have no way of actually earning that income back.
Wow! So a double whammy.
There's a double whammy. So that's where it gets really complex, and we need to model out these scenarios for our clients. So yes, that is just the one piece I wanted to mention that people sometimes forget that actually is something that we need to take into consideration.
Very, very, very good point. Because I say triple whammy because the emotional roller coaster of losing twice.
Yes. We need to take emotion out of it when we're looking at this. Yeah, absolutely.
So let's talk about 83B.
Yes.
So for folks who are not familiar, never heard of it, what is 83B? Who does it apply to, and like what are like the benefits for it?
Yes, absolutely. So 83B essentially allows you to pay the tax liability when those shares are granted to you.
Okay.
Right. So again, right, you don't pay the tax until they vest typically, or when you exercise. This gives you the option to pay it when they're actually granted to you. Now, it typically makes the most sense for like pre-IPO or like very new public companies, right? Stock price might still be pretty low. There's a lot of opportunity for growth there, especially if we're looking at tech companies or some pharmaceutical in like the early stages, right? So you pay the tax on that grant, right? The stock might be worth less than $10, right? So you pay the tax then, and then once it actually vests to you and you go ahead and you exercise or you sell the shares, then it's just long-term capital gains rates or short-term, right, depending on how long you hold the shares for, right? So again, it makes a lot of sense if the company's at a lower valuation, and you have confidence that stock price is going to grow significantly. The one caveat is that you need to file this 83B election with the IRS within 30 days, and there is zero leeway on that
Okay.
30-day time frame.
Wow.
So
Okay.
once the stock is granted to you, that timeline starts.
Yeah.
And if you do not actually file this within 30 days, you completely lose out on that election altogether.
Wow. Yeah.
Right.
Yeah.
So very short time frame to
Mhm.
make a big decision.
Yeah. 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 And potential decision that can save you a lot of money on tax
A
depending
lot.
on the company.
Absolutely.
Of course, a lot of different variables, but if you have a grant, most of the time, if you're at a company that does well over time in the future, typically it can do well.
Absolutely.
So what would be like the big risks, right? Like, of course, there's always, the pros and cons of everything. Like, what is the
Mhm.
risk to like an 83B election?
So if you actually go ahead and file that election,
Mhm.
you pay the tax right up front, right?
Mhm.
So again, if the stock does not end up doing as well as you think it will do, you're paying tax on a larger amount
Mm,
than you would have otherwise,
got it.
right? So again, a lot goes into it, right?
Yeah.
We really have to model out different scenarios,
Yeah.
and you have to understand, what the overall tax implications are going to be.
Yeah.
And you also have to pay that tax bill,
Yeah.
up front
Up
as
front.
well. So
Yeah.
you have to have, the liquidity to be able to do that.
Oh,
Yeah.
interesting.
Yeah.
Yeah. Have you seen anyone take advantage of this in the past?
So I've modeled it out for a few of the families that we work with. We've ultimately elected not to go
Mm,
forward with it, right?
yep.
But yes, this is something that we look at for every situation. Again, it is a little bit more niche, right? It only really makes sense for companies that are in the earlier stages. But yes, we have,
Yeah.
it makes sense to at least look at the pros and cons
Yeah.
of if we want to do this or
Yeah.
not. Yeah.
And that's something too I appreciate is just because you have the ability to do something that can potentially be beneficial doesn't mean you should always do it.
Exactly.
Right.
Yeah.
And I think that's something that it's good to have someone on your team. Like, hey, listen, A3B sounds great.
Mm.
You apply for it. Yes, the company might do great. It might save you taxes, but there might be other reasons why we shouldn't do it. And that's something I feel like a lot of folks who are like the DIYers or maybe just might not have like a professional in their corner don't really have that kind of process of like, hey, this is something that's quote unquote good, so they think they should do it, but sometimes you shouldn't, right?
Absolutely.
So
Yeah. You really need to weigh that out.
you gotta weigh it out. Yeah.
Yeah.
Cool. So I guess before kind of we wrap this up, I know I'd like to really talk about, and this is kind of connected, but just the risk of equity compensation, right? There's a statistic out there that, 70-80% of like wealth accumulation outside of real estate is through like equity compensation, right? Because folks work there, they have a good salary, they move their way up the company, and on top of the salary that they're already earning, they're just getting all this company stock dumped onto their net worth in a good way, right?
Yeah,
Like,
yeah.
which is awesome. It's great. These companies take care of their folks. But I think what I've noticed as well, and keep me honest, a lot of people get like sentimental and they're like, well, I've had Johnson & Johnson forever.
Yeah.
It's a household name. It's, 30% of my portfolio. I don't see anything wrong with it. Talk to me about like how you kind of work around that decision making. One, quantitatively,
Yes.
like how we look at that in our planning.
Yeah.
And then also like qualitatively, like how do you help your families think about like, hey, you've got $1 million of Johnson stock. Like, what are we doing with this?
Yeah, that's a great question, and this is where it definitely gets a little complicated. And we have our beliefs, and they have their beliefs, and we kind of sometimes need to meet in the middle. But I'll reiterate: you need to take emotion out of it, right? I understand you believe in the company that you work for, right? You always think that it's going to go up in terms of the stock price, right? But that's where we have to look at it through a different lens and actually look at it like quantitatively, right? So is it a concentrated position in terms of your overall portfolio, right? And what I like to do is model out different scenarios where at that level, what if the stock drops 30%? What if it drops 50%? And in a worst case scenario, what if it drops 80%, right? And I think when I illustrate that out for folks, right, and they see the impact that it can have on their overall portfolio value and net worth, that's when it becomes, a little bit easier to make some of those decisions, right?
Mhm.
So we have to walk through all of those scenarios to, truly determine, what when we want to time this out, right? And how essentially we want to go ahead
Yeah.
reinvest those funds and diversify, right? You can have belief in your company,
Yeah.
and still want to diversify
Yeah. Yeah.
over time, right? Both
Yeah.
can exist.
Yeah. True. Yeah.
So yeah, we have to kind of separate the two. You have to take out emotion, right? And we have to look at, the numbers, and also never look back and think like, what if,
Yeah.
right? We have to be confident in the decisions that we're making,
Mhm.
over time, because they are going to work out for you,
impact
right?
you.
Yeah,
Yeah.
absolutely.
Yeah. And that's a great point. That concentration test is very key, because
Absolutely. Yeah.
also it gives folks real feedback, like, hey, this is the real risk that's on the table.
Mhm.
A lot of it's can be theoretical, say, hey, you have concentration risk, and people know what that means, kind of.
Mhm.
But when you see in black and white, and also sometimes in red, right, if
Mhm.
like how it impacts actually your ability to potentially put your kids through college, retire on, with confidence, or what other financial goals you may have, that also helps them really understand and think like, okay, maybe there is too much risk on the table.
Absolutely. Yeah.
And one thing too, I also want to add to folks is a very simple test, right?
Mhm.
Like, let's just use Johnson because we've been
Yeah.
using
Yeah.
as an
Absolutely.
example.
Yeah.
You have, someone has $500,000 in Johnson stock. Ask them, like, I usually say, okay, if you won the lottery and you had a check for $500,000
Yep.
cash, would you buy all Johnson stock?
Yeah.
And I'd say in the decade plus we've been helping people ask that question, no one's ever said yes. No one's ever
You're always
said,
getting a no.
yeah. And it
Yeah.
could be 500K. It could be, we had someone who had like 100,000, which
Yeah.
is still a lot of
Yeah.
money.
Absolutely.
So
Absolutely.
again, that narrative of just like understanding and changing the perspective is very, very vital.
Absolutely. Yeah. And it again, we'll always look at the opportunity for growth in that company
Mhm.
as well, right? And as company stock is hitting, all-time highs, or highs that it hasn't seen in a while. Johnson and Johnson, for
Yeah.
instance, right, hitting all-time highs, right? It makes that conversation maybe a little bit easier
Yeah.
as well. Of like, hey, now's some time to take the risk off the table,
yeah.
right? We've seen that growth, we've experienced
Yeah.
it. Let's look to diversify a
Sure.
little bit.
Yeah.
Yeah.
And also, unless you're retiring soon, like, you're gonna have exposure to that company,
Absolutely.
right? Because
Absolutely.
these folks that have grants coming down the line in future years. So it's not like selling and diversifying out means like, hey, you're out of the
That's
game.
such a good point. I bring that up all the time.
Yeah.
You are not completely divesting from this company. You still have so much exposure.
Yeah.
Yeah.
Thanks, Chris. And I guess before we close out for the folks, like, if someone has equity compensation and they're looking at their portal, like, what is like some things that you should make sure that they think about or keep top of mind when they're considering their options?
Yes. So if you have equity compensation, first piece is understanding the type, right?
Mhm.
We've talked about all those different types and how they can impact you from not only a decision standpoint, but a tax standpoint. So it's
Mhm.
very important to understand those types, understand the vesting
Mhm.
periods, right? And how long you have before you need to exercise
Mhm.
any options. Also, one thing we didn't really get into was trading restrictions.
Oh, yeah, that's a good
So
point.
a lot of these companies, you have a trading restriction on when you can actually sell your shares, right?
Mhm.
So it's important to know, on top of the timing from a tax perspective, of, hey, you might only have a 2-week window where you
Mhm.
can actually trade or actively trade on
Okay.
this stock, right? And then I know we've talked about it ad nauseum, but understand the tax impacts and understand different concentration risks when
Yeah.
it comes to these shares as well. You really need to model that out and see how it integrates into your full plan, right,
Yep.
as a whole. And so that really helps you to understand overall implications, and
Yep.
then helps you to get to that ultimate decision,
Yep.
right? Definitely avoid those emotional decisions again. You really have to take emotion out of it. Look at everything from a quantitative perspective, and help to come to that decision
Yeah.
ultimately.
Yeah. And if I hear you loud and clear, I'm gonna boil it down to one word, which we like to say is like intentionality. It doesn't
100%.
mean, if you have, like, again, a ton of company stock, It doesn't necessarily mean you have to sell. It doesn't necessarily mean you have to hold.
Yes.
But have an actual intentional decision. Because again, a lot of new folks we work with, they have all this stock and they're like, yeah, I just never really knew what to do with it. And it just, the inertia
Hear that all
of
the
no,
time.
no
Yeah.
intention, just, so having a plan, also maybe working with a professional who does it, wink, wink. Yeah, and just don't, ask for help and understanding. So,
Yep.
Chris, I appreciate you taking the time to really help break down stock options and equity and how it really can impact folks' lives, from a tax perspective, especially. And yeah, anyone else out there, if you have anything you would like us to talk about, please let us know. We appreciate always folks kind of send us, hey, we want to learn more about XYZ. And yeah, we'll see you next time.
See you next time. Thanks for having me, Jack.
Thanks for coming, Chris. High five.
Woo!